Welcome back to Scouting for Growth. Today's guest sits at the crossroads of insurance tradition and digital reinvention. James Birch is the Director of Strategic Technology Solutions at Key Insurance, the first fully algorithmic syndicate in the history of Lloyd's of London. If you are a broker who is ever wished you could lock in follow line capacity in seconds rather than days, you have already felt Key's impact. Indeed, built in partnership with Google Cloud, University College London, and Brit Insurance, Key uses live data and machine learning models to generate bindable quotes at the speed of a mouse click. Yes, a mouse click, freeing brokers to focus on advice, not admin. James didn't arrive here by the typical underwriting route, though. He actually began his career on the venture capital side, backing early stage fintech and insurtech startups before crossing the table to build one himself. That's when I met James, actually. That investor's eye for scalable tech now powers his operator's mission. Blend frontier data science, disciplined governance, and human judgment to make risk transfer faster, fairer, and radically more efficient. So in today's conversation, we will explore James' journey from VC to algorithmic underwriting pioneer, what a director of strategic technology solutions actually does day by day inside a digital syndicate, the partnerships, cloud architecture, and data streams that let Key quote in seconds, actually 7 seconds. The biggest trend shaping algorithmic underwriting 2.0, maybe some of you have read my article on the topic, and what they mean for brokers, capacity partners, and the wider market. And then practical takeaways for anyone who wants to thrive as the next wave of automation rolls through specialty insurance. So, whether you are chasing capacity, chasing efficiency, or simply chasing the future, stay tuned. James Birch is about to show us how technology is rewriting the underwriting rulebook, one algorithm at a time. Welcome, James, to the Scouting for Growth podcast. Hi, James.
Hi.
How are you?
Yeah, I'm good, thanks. Great to see you.
Great to see you. Well, welcome to Scouting for Growth.
Thank you for having me.
It's an honor to have you on the podcast. And so let's get started to get to know you. We know each other for quite a while, I think 8 years.
Yeah.
So let's just get into the background.
Yeah.
You know, how we met maybe, and what has been your progression from being a VC, working for startup, and now leading, operation at Key?
Yeah. So I think we actually met back when you were running Startup Boot Camp back in the Tower Bridge area. So, I've kind of been on a bit of a different journey. Now at Key Insurance. Back then, I was actually maybe even working for EY, and I was kind of desperate to get into doing my own thing and giving a startup a go. And did a startup with 2 friends, and it was amazing. A business called Pluto. We gave it a real good go, but ultimately it didn't work out. It was, we thought it was a good idea, but doing a startup's really, really hard.
Yes, it's hard.
And it didn't work out for us, which was a shame, but learned a lot and really enjoyed the journey. So after that, I kind of moved into the VC space to invest into, entrepreneurs and great founders. And that's the main thing I really enjoyed about the role, was meeting amazing people and hearing their story and understanding where they'd identified kind of opportunity spaces to go after. And I think that's what I actually then, after doing that role for a couple of years, what I kind of missed was being on the operating side, solving the problems. I think VC is a great career for anyone, and it's a great place to be. But for me personally, I was I kind of wanted to go try and, solve that problem myself rather than, trying to give advice or whatever it was, on the sidelines. So that's kind of, ultimately why I joined Brit Insurance originally in 2019 as head of innovation. to help them with their idea, which we ultimately became Key Insurance, and 5 years later, here I am, still there. So yeah, been a ride, but thoroughly enjoyed it.
So one question that comes to mind is, when you look at your VC career, what part of the toolkit have you still taken into your role today and guide some of your decisions at Key?
So I think there's like the kind of standard stuff around the corporate finance, right? Like, my role right now, I can still run the corporate development, and strategy teams. So like naturally, like I get involved in that type of part of the business. And I think the thing that really the kind of like the piece from the toolkit that I really carry through is that kind of, as I mentioned earlier, the opportunity spaces and identifying those kind of like broader macro trends in the market. Because I think for any business, like you need to evolve as the market evolves and the market dynamics change, and you've got to react to those, and you've got to be thinking, a year ahead, 2 years ahead, 5 years ahead, whatever it might be. And that's the thing that I think I've carried over really from VC, is being able to try and look at those opportunities. And particularly for a business like Key, where it's a growth stage business, we're not an incumbent, we're trying to fight our way to win business and ultimately to grow. Like, we have to do something different from everyone else to try and like position ourselves a little bit differently and and try and get competitive advantage where we can. So trying to find those opportunities is really important. And that's definitely the main thing I think I carry over from the VC space. I think kind of like one other thing is actually in terms of unlearning. So I think it's less about like unlearning, more about like when you're in a VC, you're in quite a privileged position. You're providing that advice, as I said earlier, but it's so tough once you're in the operating side. And actually, a lot of it is just like luck and good timing, and you've got to have a great idea, sure, but you've also just got to have got to ride your luck and have good timing. And that's something that I think in terms of unlearning is like realizing that a lot of it, you make your own luck, sure, but you've also just got to, when you get that right opportunity, you've got to execute on it and really go for it.
And we have seen, ups and downs in the VC world, right, in recent months. So on a normal day, where do you spend your creative juices, your creative energy?
Yeah, so I think my role now, I run strategic technology solutions at Key. It's kind of like three parts, really. Like, part of it is your classic kind of corporate strategy role, so dealing with our shareholders, dealing with our executive committee, dealing with corporate strategy, all that kind of like standard stuff. The other third is BD and sales, so like we're trying to find kind of strategic initiatives to work on with our key partners, whether that's brokers or carriers, to trying to like deeper integrate with both of those and both sides of the value chain, try and find collaborative opportunities and to work on. And then the kind of final third is the execution on those projects. So more of like a project management role in many ways, I suppose, but like running a team of people, and that could be anything from 10 to 40 people to go and deliver on one of those opportunities we've identified. And to kind of bring it to life a little bit, we recently launched an initiative with Howden, large broker in the specialty space, where we're working with them to enable kind of digital distribution as a concept. So kind of running that as a project, really. So
that's cool. So let's dive into Key and Key algorithmic engine, right? Because I remember a few years back when you launched this algorithmic underwriting proposition, and you took the whole market by storm in some ways. So, what does it take to launch, a proposition like this and give brokers, bindable quotes, in hours, I guess, not days, and
seconds even.
Oh, seconds. Okay, like share more. What does it feel like, and what does it mean for a market which often, I was a broker. I used to own those things once upon a time.
I think, look, when we started back in 2020, really, with the ultimate, like, it sounds a bit bullshitty, but it was like, what is the digital model of the traditional model? Where is the toil in the value chain and the broker's workflow and process, and how can we like simplify it, make it more efficient, try and use basically digital capabilities that, frankly, like I'd seen before in the VC space, looking at the fintech industry and the insurtech industry and like other financial service markets, and saying like, everyone else is digitized. Lloyd's of London has been like the last market to digitize. Why can't we don't need to build everything from new. Why don't we just learn from the others where they've succeeded? So really what we were trying to do is, I think table stakes in many other industries, frankly, but just trying to digitize the workflow. So the broker logs on, they type in some information about the submission for their client into a web portal, into a web app. And then that information goes into a machine learning model that also takes data from other third-party data sets. And, I can give some more detail about how it actually works in practice. And then ultimately provides them back with a quote, right? And that whole thing takes 7 seconds. So
7 seconds.
Yeah, on average. So that is like what we've really tried to do is look at all the bits that we can try and make more efficient, try and remove the paper trail, try and make structured data in, good data in means good data out, etc., etc. All the classic stuff that you'd see in many other markets and you've seen all the startups do for years. So, and I think we've always tried to like keep that through the model. So even now, 5 years later, like the algo is far more complex than what it was 5 years ago. It was 4 out of 10 then. Let's say it's an 8 out of 10 now. Whatever it might be. And we still, I think, sometimes even us, like we trip up on ourselves a little bit by always trying to overcomplicate things.
Yeah.
And like a good example we had randomly recently was is a certain class of business where capacity is almost provided in blocks. So it's like 5 million, 10 million, 50 million, 20 million. And the algo was kind of offering line sizes, of 7 million, 9 million, 16 million. But that's kind of actually not that useful for the broker. So what we've had to do is sit down with the broker and work out, okay, what's 5, 10, 15? So actually, let's kind of snap the line size to those capacity blocks and inverted commas. And suddenly, the product's far more usable in that class of business than it was previously. And those are the kind of nuances where it's classic speech a customer, hear their problems, understand what's not working for them, and try and make it a really simple transaction for them, and then they'll use your product, right?
Yeah. I remember the time when going at Lloyd's, right? You would go at Lloyd's, it would already take 15 minutes to get into Lloyd's. Then you would queue to actually get to talk to an underwriter, right? And then you would have to go to different boxes to get your line. So, moving to seconds.
And then you play Candy Crush on your phone while you're queuing.
Well, at the time, I can't remember whether I had Candy Crush on my phone.
Snake on the phone, maybe. Yeah, exactly.
While waiting. So, often we talk about insurance and, we think about insurance not making much innovation, but actually key part of the transformation of the Lloyd's of London market, right?
Yeah. I mean, we're trying, and I think Lloyd's is like, Lloyd's as a market has been like very, very supportive to us, and that's been really important. I think for we wouldn't be where we are today without the support from Lloyd's, because they see that the market needs to digitize, needs to improve, and that us as I suppose like a case study or a player in the market, is something they want to support. And we kind of have to live and breathe by all the same regulations as all the other kind of carriers, underwriters in the market. But we've obviously taken a very different approach to underwriting than others. So bringing them along on that journey has been really important to help them understand that it's not a black box. It's not just like a computer, and it is doing proper underwriting, and we're pricing, and we're assessing risk, and we're doing aggregations and exposure management, and all the good and proper things you should be doing as an underwriter. But I think in terms of where the Lloyd's market is going is, it's been really hard. Like, it's a really hard market to digitize because by the nature of it, you've got so many market participants on both sides, brokers and carriers. And you're trying to regulate all of those and trying to get all of those companies with different internal politics and incentives and et cetera, right? Trying to get them all along to move along and digitize. It's really, really tough. And so I think, that's ultimately one of the reasons that we started Key was we looked at Blueprint 1 and we agreed with everything that was, the original kind of McKinsey strategy document that Lloyd produced. We agreed with it all and we said, actually, you know what? We think there's an opportunity for us to go and build something here which does try and digitize the market. So rather than like waiting for everyone else to digitize, we're going to give it a go and make a bet. And, I suppose it's great that we did and we took that risk. And, and kudos ultimately to Brit, where Key was incubated out of, because their exec team were willing to take that bet at the time.
And that shows that also within the market, we actually have our own startups, right? When you think about Key, it is a startup coming out of Brit,
Yeah.
right? And so venture building, therefore, is happening in some way or shape within our market.
Well, yeah, I mean, technically we were in 2020 we raised $500 million, right, from Blackstone and Fairfax. So technically it was the largest fundraiser, I think, fintech in Europe that year, but it's obviously like slightly different because it's not kind of, two individuals and their dog working out of a garage, starting from nothing. Like, we had a lot of unfair advantages and, support of Brit and Fairfax and others, right? So, I get that it's not kind of a pure play startup, but
you have to start somewhere.
Yeah, exactly. And I think, but there's something interesting in that, right? Like, I think, like, my view of like why I went to kind of Brit originally is I saw all those unfair advantages. I kind of done the private startup, it hadn't worked out, it failed. And I was like, actually, like, these guys have got so many unfair advantages. They got the capital, they got the distribution, they've got, the talent, they've got the access, they've got the regulatory, like, all the barriers to entry were removed.
Right, yeah.
And I was like, this is kind of set up to win. And so you can kind of like do a startup within a bigger corporate or a bigger incumbent. And yeah, like, there is always difficulty doing that as well in terms of bureaucracy and red tape and stuff like that. But I think Brit were very good in removing a lot of that, those internal challenges, so that, ultimately the business succeeded. And I'm actually surprised there aren't more kind of greenfield startups that come out of corporates in insurance or financial services more broadly. I think you've seen it in banking a little bit, right, with Metal and was that NatWest and
I mean, you have
SME Bank and
shift. I mean, a lot of the shifts, I think, in finance has come from fintech and payment in particular, right? And so I think some of these ideas are coming into our industry, like open banking. Are we going to have open insurance, data sharing, and so that we can actually serve the customer better? I mean, in your case, you were fortunate to work with Google Cloud. I believe UCL as well was involved into your partnership. What was the role of its different constituents?
Well, I think, actually, in fairness, this kind of like leads on from the last point around like doing a startup business or venture from within a corporate. I think kind of like, so, we looked at Brit and Brit kind of had all the market knowledge and it had all the claims data and, it's an underwriting firm and very successful underwriting firm. So it's very good at underwriting, but admittedly it didn't have the technology talent, right, to be able to build an algorithmic underwriting, in business. So we kind of said, okay, well, we've got two options here. Rather than one, we could go try and hire all this talent. Mm-hmm. But actually, we didn't have any brand or any kind of like brand halo. And like when it came to like technology, so like how are we going to attract the best like tech talent into the business? It's going to be tough. So we went for, rather than build, we went for a partnership model. We didn't go for the buy because we wanted to own the IP. So they're obviously the three classic options. So we went for partners. We approached Google Cloud and we said, look, we're going to build this thing. Do you want to join us? So kind of Google Cloud were great, and they helped us with the underlying like technology for the web app. I kind of think about it with the front end of Key, and then UCL helped us with the kind of algo piece. So Google was Google, everyone knows them, and UCL at the time still are kind of the leading academic experts in algorithmic trading in capital markets, and helped some of the original kind of quant-based hedge funds. And so that's why we approached those guys, because we wanted to have an academic lens to the algorithmic piece, and then we wanted to have, a big kind of tech firm on the front end, because it brings that brand halo as well, and you get access to some great engineering talent. So the first year we were kind of leaning on both of those two companies for the technology resource and talent, and then over time we kind of wound down and hired up our own internal teams, and our director of algorithmic underwriting, loves to say the fact that 4 years on, there's not a single bit of code that remains from UCL. We've now rebuilt it all, and we've changed it and improved it and whatnot. But they were great partners, and I would always recommend. I'm a big advocate of the partner model, because I think if you get two like-minded or three or four, however many it is, partners, you can build something really great together, and you're all kind of invested, you're all strategically aligned, and so
it can create that hopefully network effect where one and one equal.
It's all about talent, right, and access to the best talent. And we were just open with ourselves at the time. We did not have the right talent to build it. We had a good idea, we get market knowledge, the understanding, but we didn't have that bit. So they kind of worked with us to kind of plug that gap, I suppose.
You mentioned, looking at Lloyd's, and you read the blueprint as well. When you start looking at what you do, how does regulation plays into it, right? Because you still have to have the right guardrail when you're actually automating aspect of the underwriting process. So what does the governance look like when you look at Key and the work you are doing with the brokers?
I think so. Like Lloyd's of London is a heavily regulated market, and for the right reasons. And so we have to obviously abide by any of the same regulations that any carrier or underwriter do in that market. I think, as I said, kind of mentioned earlier, like our approach from day one was really engaged with the regulator, and in this case predominantly Lloyd's, but also the PRA and the FCA to an extent. Engage with them really early, explain what we're trying to do, be really transparent and open, be really honest about where the gaps are and where you haven't got to a certain level of maturity yet. Don't overstate that this algorithm is going to be, the best thing since sliced bread, and where it's good, and where it's not, and be honest about that. And where it's not so good, say, look, this is the way we're going to govern it, and this is how we're going to be tactical, and we're going to make sure we have, human oversight and proper controls in place. So I think kind of the way we've always approached regulation is being very, very engaged with it and taking it very seriously, rather than you see like other startups in the fintech space being kind of like 2 fingers up to regulation and trying to avoid it almost, and then getting fined later down the line and all that kind of stuff. We're the complete opposite. We're kind of, we try and we spend a lot of time with Lloyd's, and I think that's helped us a lot because they've been highly supportive of us and our growth through the last kind of four years, and they've allowed us to kind of grow as the market's grown as well. So so my advice to anyone would always be to work with your regulator, be transparent, and if they get it and they get the model and they understand it and they see the value you're going to deliver to the market as a whole, make the market more competitive, better for clients, they're going to support you. And they're going to help you grow in the right way.
So PRA, I mean, is interesting, right? Because you're interacting with the PRA. And so their response was probably, I guess you said, supportive because they wanted to introduce more competition in the marketplace. I mean, did you have to actually interact with them on a regular basis? I mean, you highlighted at the end of the day, in finance, in general, we have to be super transparent and actually build that trust, right?
Mm-hmm.
And so what was your relationship with an organization like that? Just curiosity, because I'm sure, people listening to you, it's like interesting, right? You had to build a relationship with the PRA.
Yeah. And I think the way that we approach the regulators is, a monthly meeting, as a minimum. And we've always had that. And then if there's kind of ad hoc things we need, then it's like they kind of like assign you, you get assigned like an account manager or case manager or whatever it might be, different with different regulators, and just working with them to problem solve together, rather than saying like this is the answer and we know what the answer is. So, with all of the above, we kind of always approach it monthly meeting, and if you want more time in between, we're always open door, happy to give it, trying to share more information than they kind of actually even ask for, so that we're kind of preempting any questions.
So let's talk about the broker and how you drive value for the broker. So from my understanding, right, when a broker interact with your platform from first click to final bind, what is a moment in the journey which is critical for them to actually understand the value the platform is providing to them? How does the whole framework works? And I'm thinking, you said 7 seconds. What is the difference between lead and follow?
Okay, so a few different questions I'm going to try and unpack there. So I'll start with the last question first, that's okay. So like lead follow is like a little bit of a Lloydism. It doesn't it does exist in broader commercial insurance, especially insurance, but it's kind of mainly predominantly seen in Lloyd's. So to walk you through kind of the broker's workflow, the broker, let's say from a Marsh, Willis, Aon, one of the big guys, working for a big client like a Marriott Hotels or something, big kind of like S&P 500 type company. They're trying to place all of the hotels on the, East Coast line or something like that. They place some of it locally in the local market, then it goes to the wholesaler, then it will for the specialist stuff, and that might be something like total loss events like a hurricane or a wind event or something like that. Those type of things come to London and ultimately Lloyd's of London. Then what happens is they go and find a lead underwriter, and that lead underwriter will negotiate the terms of the contract. So what they're going to insure them for, what they're going to cover them for, what they're not, in what events, in what scenarios, and to the price, right? So what the premium is for the coverage. The lead underwriter will normally take, I don't know, 30 to 40%, but on average, let's say 40%, just for easy maths. Then the broker, in the current market scenario, they will place a broker facility, which is like an internal thing, and a facility will normally be 20%. How a facility works is a load of insurers have effectively taken a quota share of the broker's portfolio or a percentage of an index of. So 40% on the lead, 20% on the broker facility, and then the remainder is follow. So you as a market, or carrier, like Key, there's 40% of the market left. And of that remaining 40%, you might offer 5%, you might offer 10%. So there might be anything from 1 to 5 follow markets. So that's kind of how a contract or slips made up in Lloyd's. So Key is a follow only market. So we're not setting the price, we're not setting the terms. The price and terms have already been set by the lead. So the broker will negotiate with the lead, and that was kind of part of the original thesis, was there was a load of extra cost and expense in the market because the lead underwriter is doing all the KYC, doing all the pricing, doing all this, doing all that. And then the follow markets are doing it all themselves again and again and again. So it's just adding a load of cost into the market. So by us trying to digitize the follow piece and like automate the follow piece, we can leverage some of the work that's been done in the value chain, and then try and like ultimately get a quicker, cheaper quote out to the broker. Because if the broker's already done all the negotiation with the lead market on terms and price, why do they need to then go and negotiate again with each of those, let's say 5 follow markets in this example? So really that was the main kind of cost save for the brokers, on the OPEX side, is they don't have to have loads of brokers running around the Lloyd's of London building. They can just have the broker negotiate with the lead underwriter, come onto the Key platform for the follow, and then go and spend their time on new business opportunities and new client opportunities, rather than spending their time running around Lloyd's trying to get the final little 2% on a slip or something.
Yeah, and that is often what takes a long time. So Key now writes alongside other digital capacity providers, right?
Yeah, that's right.
So I read like Aspen, Beazley, Travelers, QBE.
Yeah.
So it would be important to understand what that means for our listeners, and what the differentiated aspect of your algorithm, right? How it plays from an appetite viewpoint, and why a broker should think about Key first.
Okay. So I think so we launched this kind of capacity partner proposition last year, which is what you talked about with Aspen and QBE, Travelers and Beazley. So how that came about might be good context. So that original example I was just talking about, kind of the lead and follow model in Lloyd's, over the last 3 years, 2020 to 23, when you came onto the Key platform, you type in the information, you click get a quote, and then you get a quote from Key. And the quote would be a percentage of, 100%. So let's say we were offering 10%, but of the follow portion, there was 40 available. So we're only covering 10 of the 40. So there's still 30% you have to go and place in the traditional market. So yes, it's great. Key can offer a quote really fast, but ultimately you still got to go back into the Lloyd's market to go place the other 30%. So, but we were getting the senior leaders and some of the brokers saying, well, why can't you just do the whole 40%? Now, our balance sheet wasn't big enough to do the whole thing. So really what we did is we ultimately reached out to who we thought were considerable players and leading players in the Lloyd's of markets. You've got Beazley, the largest, QBE, the second largest, Aspen, they've just IPO'd and very successful business, and Travelers, one of the biggest kind of players in the kind of US P&C market and commercial market more broadly. We approached those guys and said, look, come join us, put your balance sheets alongside our balance sheets. And now when you come on the Key platform, you do the same thing. You type in the information about Marriott Hotels as the example, click get a quote, does the KYC, AML, risk pricing, risk aggregation, etc., get your quote back. And then you get a quote from our syndicate, 1618, Key, Aspen, Digital's their syndicate name, the Beazley syndicate, Travelers syndicate, and then the QBE syndicate. And then as a broker point of view, you could either take all 5, we could just take 1, you could take 3, you could take 4, whatever, combination you want. You could sign, you're not allowed to sign anyone up, but you could sign one down. So it's a free competitive marketplace is kind of how we think about it. So the dynamic is the broker can come to Key, they can get all their follow capacity all in one place, all at one time. They're not, they still own the client, they still own the transaction, they own the distribution, they don't, they own how much they want to place with different markets. So that's kind of what we've basically tried to recreate the traditional follow market digitally.
Mm-hmm.
And that was kind of the change in our business model last year, which has been, really well received from the brokers and being highly used. And, and that's kind of grown into this year. And yeah, we think that's kind of worked really well. Your second question in terms of, I suppose, like, how does the algorithm work?
Yeah.
And what's the benefit there for the broker? So the benefit of the broker is speed, really, like speed and simplicity. Like, it allows them to get a quote so fast, and they have certainty on the capacity as well. So they can provide certainty to their client that the capacity's there, and the capacity's there early, which ultimately allows them in most cases to win business when they're tendering too, because it can take weeks for a normal market or carrier to get back to them, whereas Key straight away. So we find them using us a lot very early in the kind of like process, particularly when they're negotiating for new business. And then how the algorithm works, ultimately it's the same as any other underwriting capability. If it was traditional, like an underwriter, it's, the submission comes in, we then price the risk. Now, we don't offer a price because we're a follower, but for our own benefit and, as part of regulation, we have to price everything. So we say, do we think the pricing strength is good or bad on this particular risk? Then we assess the attributes of the risk. It's that hotel example, it's got a flat roof, pitched roof,
Mm-hmm.
how many rooms has it got, all that kind of stuff. Is it near a flood zone, etc. And then we do and then we take that information and we do kind of live aggregation work. So we're looking at how many hotels we've already quoted in that kind of area or geography or jurisdiction. If there's two hotels next door to each other, maybe that's not as good a thing, so we don't want to insure both of them because it's high aggregation. So we do that on our quoted portfolio and our kind of bound portfolio, then we match those two things, and that goes as an input into the algorithm. And then the final bit is the kind of human oversight part. So like we call it dials, but basically it's like we have, our underwriting team will say, we don't want to write as much wind exposed business in this wind gate, in this 1 kilometre area of Florida because of the claims experience we've seen over the last 5 years.
Mm-hmm.
So basically we just put kind of a limit on the algorithm to what it can offer on that particular variable. So that's kind of the final step. And that's been really, really powerful actually for us, the kind of DARs and the human control. And I think that's the most important thing. And that's actually been really important, going back to Lloyd's, for them, is to ensure that the algorithm isn't just going off in whatever direction it wants to, and that we've got that human control and oversight. And I suppose one final point here is, why did, an Aspen Travellers, QBE and Beazley sign up to us? It was really like the fact that, yes, there's a big efficiency play here for them, and they can follow business in a very efficient way. But the most important thing is, because all the data's there and because we're kind of monitoring constantly, we can kind of almost try and get, for ourselves and them, ultimately the perfect portfolio, because basically, our underwriting team, portfolio managers, are kind of managing from the first day of the year till the end of the year, to managing along the cycle to get to that perfect portfolio balance and mix. So if we're writing too much habitational business, we'll wind the algo back and we'll say to the algo, stop writing as much or stop offering as bigger lines on habitational business. So then ultimately, if you see a bit of too much of a peak somewhere, then it will start to flatten off. So then by the end of the year, in theory, you can get a good balance. So that's been really, really important, obviously for our own profitability, but then naturally for our capacity partners too.
Mm-hmm. There are two parts of what you just said I would like to dive into.
Yeah.
One part is around that relationship, but looking at the risk. We are seeing a lot of emerging risk. And so how would algorithmic underwriting and what you do every day and the dialing around the portfolio plays when we start seeing more, climate risk, emerging risk, cyber, AI risk, right? And the second part is going and diving into that human oversight. So let's start with the emerging risk. Right, there are so many new risks coming to market. How does Key play around those new stuff affecting us all?
Yeah. My answer to this actually isn't that great, Sabine, which is like the reality is because we're a follow market and because we operate within Lloyd's,
that makes sense.
We don't kind of like write new products.
Okay.
We'll write what the market writes.
Offers.
So like we see some of that through certain risk codes where there might be new kind of like emerging risk coming in, or we see kind of like how do I describe it? I suppose like contract terms broadening, so there's bigger coverage for certain type of like climate events, climate related events. But we're not doing kind of like a brand new product like green credits or something like that. That type of stuff we're not doing yet. But something maybe for the future for us. So, the way we kind of look at it is, if it comes into Lloyd's and it's a risk code we're approved to underwrite and it's something within appetite, we will always underwrite it and always say yes. And really the way that we're kind of approaching those kind of new emerging risks is trying to ultimately ever expand our third party data set, because we're only as good as the algorithm's only as good as the data it's exposed to. So we're constantly trying to provide more data to the algorithm so it can learn more, so it's a better understanding of the context it's seeing. So I think that's the best way to understand that type of stuff. But I think the true answer is we're 5 years old as a business. We're not quite there yet for some of the new emerging stuff, and we're still kind of very focused on our core classes and getting to a level of maturity in those, which is property and cyber is one of them, but cyber property. Some of the FinPro classes.
Interesting. Yeah, because, I always get into that emerging risk conversation. I always wonder, are we able to take those new risks now? And actually, when you start looking at digitizing a marketplace, that could be a great place to have the transparency and the visibility of how those risks are evolving and whether there is enough data in the market to start underwriting them.
I think there's it's a great opportunity space for people and for people to look at. I really believe that, but kind of like the problem that we're solving as key is not kind of like the insurance gap and new emerging risk. That's not the bit we're focused on. I think we're like trying to focus more on trying to improve the core underwriting capability and make the way that you underwrite more efficient for the market and for the client ultimately. Never say never though. It's something I think we'd love to do, but just like having the bandwidth is the problem,
you're
right?
probably already kind of busy as well with
exactly.
a lot of things coming at you. So now when you look at human expertise, right, we are talking about algorithm and underwriting, and at the same time we talked about the guardrails. So when we start looking at human expertise still matters. I am sure there's no doubt here.
Sure.
So where do underwriters step in? How they collaborate with the algorithm to actually drive that efficiency, but at the same time be able to underwrite more business faster.
Yeah. It's it's been a really fascinating journey, and like transparently, I think it's something we've quite nailed yet actually, and we're always still working and trying to improve on. So kind of the algorithm is the way it's built, designed, operates is ultimately built by a kind of technology team, which is a classic and agile approach. So like product managers, engineers, etc. However, we then have like a divisional alignment. So we'll have a core portfolio as a property, casualty, and specialty. So we'll have a property division, and in the property division there'll be 1 or 2 squads that are working on improving our technology within property and our algorithm within property. And then you have the divisional kind of director or property director, it's the underwriting director, and an underwriting team around them, and they work like in lockstep with the technology team to say, look, from my experience of running property portfolios for the last 20 years, you need to design the algorithm this way, we need to consider this factor or that factor. So they're kind of like collaborating, working together to build ultimately like a digitized version of kind of that person's underwriting experience. So that's one thing, is working in a really collaborative fashion of underwriting and technology, and not thinking of technology as IT. Like you always see like the IT department, and like don't think of it as an IT department, like working with them as a peer to build like a capability together. That's been really important. And and that's kind of my point when I say we're evolving that model. We still like it's working. It's always a work in progress, and we only just more recently moved to this divisional model. Previously we had more of kind of like a horizontal way of approaching it, which was great for the first 3 years, but actually as we've now matured, we need a bit more focus on going to the next level. Then the other factor is the human oversight in the underwriting process itself. So making sure that there are proper controls along, when the algorithm is making decisions, and there is that ultimate human oversight at the very end. So to bring it to life, another example, when the Ukraine-Russian war happened or started a couple of years ago, we took the decision that evening at the underwriting committee to stop writing, any business in Russia. So we took the call, and then overnight, one of the algo engineers went in, put in a dial, and basically the algorithm stopped writing business in that geography going forward. Other, not to slam any other carrier in the market, but other players in the market, they did the same thing. They had an underwriting committee, they made the decision, but then they've got to communicate that to humans, and humans take a time to communicate it, and someone's sick that day or someone's on holiday, and you lose a day, you lose a week, you lose another week, right? So actually,
and still
underwriting things they probably shouldn't be underwriting, right? So it's really that level of control is actually far better on the algorithm than it is with a human-led model, which has been, really important for us and the regulator as well, and our capacity partners, and they've really found that important. So I think they're the two main things to call out. The other thing is, again, we have all the classic underwriting committees and portfolio underwriting committees and all the governance structure in place that any decision about any change to the algorithm, small minor things, sure, they're just going into production all day long. But if it's a major thing like that kind of example I mentioned just then around that scenario, that's something that goes to a committee before it actually gets deployed. So, we make sure that we have the human control so that people aren't just doing things on the fly as well.
Yeah, so important. So let's talk about sorry about that. Let's talk a bit about the future and future trends. We are talking about underwriting. We are talking about Lloyd's. We are talking about Key as an emerging player into the market, right? 4 or 5 years old. So when you start looking at the algorithm itself, what emerging inputs do you think are very valuable when you start actually pulling this, let's say pricing and underwriting together? Satellite imagery, IoT, generative AI simulation.
Yeah.
Are those things you are looking into and to augment further what you are doing at Key as well?
Yeah, honestly, all of the above. For us, we're very kind of data hungry, I suppose, because the algorithm's only, again, as I said earlier, the algorithm's only as good as what you put into it. And, we need the good, high quality structured data in. And if you put bad data where it's got mistakes or there's missing inputs or it's not structured, we can't really do anything with that. So I think there's a couple of responses to this question. One, yes, the satellite data example, trying to find third-party data sets to supplement kind of our claims, core claims information is really important to provide a richer view of a given client or risk, and kind of a 360 view of that client is really important. Another kind of factor is trying to think about clients in a class agnostic way. So thinking about the Marriott example, not just their property exposure, but also maybe their cyber exposure, because we might also cover them for cyber insurance as well, and also their D&O, and also their whatever it might be, right? So how does that aggregate on a client basis rather than just on a class? Because most underwriters think class by class and don't think just on a client basis. So taking a different approach there has really helped us actually. And then the final thing, and actually I think this is the most important for the market, is we've been spending a lot of time with our broking partners to try and work with them to support them on their technology journeys and their digital journeys, to try and help them structure their data and play back their data to them in a more structured format, because ultimately they own the client data. So if their data structure is not there, then ultimately we struggle to provide a quote back. So working with them to help them to structure it and ultimately improve it for the whole market, because the market's not only going to digitize if the data quality and structure is better in the front end. So we've been spending a lot of time there.
So you have been leading, the team at Key has been leading transformation in our Lloyd's market, the marketplace for insurance. So as the market evolves, do you foresee, fully automated follow lines happening in that market? Do you see that becoming the norm across, at least the traditional lines of business that we've talked about?
I mean, I'm probably paid to say yes, but I genuinely believe that the answer is yes. Like, I really just don't understand why you wouldn't use this type of capability. And it doesn't need to be just Key, right? There are other players in the market, and it's good for the market if there's like healthy like competition in the digital space as well. But I think it's for the good of the market that if Follow Business is placed fully digitally, then everyone wins. The carriers win, the brokers win, and the clients win. Everyone saves money and saves expense. So if we're not trying to digitize the market, then we're just overcharging the clients ultimately for our own inefficiencies.
Yeah.
So I think like the market kind of should digitize from more kind of a conceptual theory point of view. And then two, I think we're truly seeing it. I think, Key's not in a class of one anymore. There are kind of other options out there, which is great to see, and we're really supportive of that because our view is the bigger the addressable market, the better, and and everyone can kind of grow together in that. So I think we're seeing more business traded digitally, and then the main thing is we're seeing all the brokers starting to digitize. I think the carriers have started playing around with algorithmic capabilities over the last couple of years, but we've seen the brokers really start to shift their digitalization programs, which is really positive for the market, and we definitely really support, because ultimately if all the brokers are providing their submissions digitally, you have to kind of be digital to be able to provide a quote back, right? So I think we're kind of at a bit of a tipping point for the market, and whether that tipping point is the next 2 years, the next 5 years, I don't know, it could be anyone's guess, but we're hopeful as Key that we'll be there to lean into that when it does happen, and we think, as I said, we think it'd be for the better good of the market if it does digitize, but I do believe it kind of naturally will anyway.
Yeah, I mean, for me, I have this vision, right? We come from a world where we had that face-to-face interaction. We were going to the marketplace. We were able to access all the syndicates and actually find those underwriters able to fulfill the need of customers, right? Specialty risk. Now, as the market become more digitized and we have different players doing algorithmic underwriting, I can see a world where, you are not covering the protection gap. But somebody may actually do algorithmic underwriting for the protection gap. And so now we start connecting through APIs those different marketplaces, and then finding more capacity for risk that did not find cover in the past. And I think that is the exciting part.
I couldn't agree with you more. I think that's bang on. Yeah, right. I really do. Yeah. And I think there's exactly. There's so much inefficiency in the market, and if we try to make the market operate in a more efficient way, then it should free up capacity for new emerging risks and things that aren't covered right now.
Right? You can see it from the data. So when you start looking at, that's going to be my final question. If you were going to leave a recommendation to the brokers, the partners you have out there, what would that be, around creating positiveness in our market and, inspiring others about the potential that still exists in our, insurance market that often people think is archaic, it's not moving along, but actually behind the scene, a lot of things are happening. What would be your top advice for them?
Oh, I'm not sure I'm the right person to give them advice because they're doing an okay job at it already. But I think just I think he's a good case study, and we built kind of a pretty good business out of kind of effectively thin air, kind of over the last 4 years, and hopefully it's a good case study if you embrace digitalization and the benefits that exist. There's massive opportunity for you, and it doesn't have to be Key as a business, right? But you can have a massive impact on your P&L and ultimately massive improvement in your OPEX and your expenses. So, there's an opportunity if you do embrace digital that you will improve your own business and the marketplace, and then ultimately everyone wins. And that's the main thing for me. So, my kind of hope and advice to everyone is embrace digital trading with both arms.
Yeah. I teach once a year at Bayes Business School around disruption, right? Around insurance technology disruption, financial technology disruption. I mean, about corporate venturing and corporate finance, but more around the venturing aspect of things and how that's helped change the way we digitize, right? And we transform our markets. I think you talked about the case study. I mean, I think I'm calling to professor out there. Maybe they should actually knock on your door like they've done for Lemonade of Pingham to get you to write this HBR article.
We can
actually teach in business school.
That's very kind of you. I'm sure our marketing team and myself will be happy to. But I think actually there's an interesting takeaway there, right? Like we not many people know much about Key, and that's because it's not like a value that we have written up on a wall or anything, but our view is always kind of leave your ego at the door and just focus on building a really great business and focus on solving the problem. And that's actually just some advice I'd give people is, you can definitely waste a lot of, not waste, but you can spend a lot of time on doing things which aren't adding value to your business. And I think that's something that Key's been quite good at actually. In hindsight, it's just been focusing on execution, focusing on ourselves, not worrying what other people say, not worrying about doing too much flashy marketing, and just being really focused on execution, which is one of those classic kind of startup
ruthless execution, and I believe in it.
Exactly. It's one of those classic startup 101 things, isn't it? But it truly is. It is true.
Yeah. Well, James, thank you very much for joining me on Scouting for Growth. It's a pleasure.
Thank you so much. Thank you so much for having me. And
I hope you enjoyed this episode of Scouting for Growth. Please subscribe, share with friends, and leave a 5-star rating. Your rating is so valuable. I review all of them, and my team help me adapt content to meet your needs. Also, connect with me on my preferred channels. I am a B2B growth expert, so you will find me on LinkedIn, Instagram, and Threads, and X as well as Blue Sky. All information available below. Until next, keep scouting for growth.